You felt it. The market pulls back. Your position is down. And the voice in your head says, this is the dip. This is where smart money buys. Well, sometimes it is. And sometimes you just watch the dip turn into a minus 40%. The question that separates institutional traders from everyone else isn't, is this cheap? It is the volume structure consolidating? Or is it still expanding to the downside? One question, entirely different outcome. And today I'm going to show you exactly how to answer it. I'm Jesper and this is Cantillon Research, where we use institutional volume analysis to read the markets the way smart money actually reads them. Not price, not RSI, volume structure. Here's how most traders make the dip decision. Price dropped X%, it's near a support level, RSI is oversold, buy. And this framework isn't wrong, it's just incomplete because it's missing the most important layer of information in the market. Price is the last thing institutions reveal. By the time price shows you a dip, institutions already know whether they are accumulating or distributing. They're just not telling you which one it is. And think about why. A fund managing $10 million, they cannot exit on a position in a single session, without destroying their own price. So what do? They sell in layers. They sell the morning rip. They sell the afternoon recovery. They sell while retail is loading up on what looks like a discount. And the footprint they leave behind is in the volume structure. And if you don't know how to read it, you're flying blind with someone else's money. So the first signal is volume compression. And this is the one that most traders have never heard of. Every market gets through cycles of compression and expansions. Compression, what my IVT terminal calls coiled, is when volume contracts into a tight range. The market is deciding, not moving. Expansion is when the decision releases as a directional move. So here's the critical insight. Sustainable trends begin from coiled states. They don't begin from expanded states. So when you see a 15% single session spike on a stock that's been in a downtrend and the volume compression reads expanded at 0%, that's not a new trend beginning. That's a release of tension in the existing trend. The spring didn't load, it snapped. A dip that holds comes from coil structure. Distribution looks like expanded. The second signal is stability reading. This is the institutional accumulation detector. The IVT terminal scales stability from 0 out of 2 to 2 out of 2. A reading of 2 out of 2 means volume is clustering at a price level. Institutions are absorbing the supply. They are building a position. That's the fingerprint of genuine accumulation. A reading of 0 out of 2 means volume is still dispersing. The profile is still expanding lower. No basis forming, nothing is being absorbed. The third signal is the AVWAP direction. Anchored VWAP. And this is the one where the subtlety matters most. Most traders, they know regular VWAP, the single day institutional reference price. Anchored VWAP is more powerful. It anchors the volume weighted average to a specific structural event. It could be a high, it could be a low, it could be a regime change or earning, and it tracks institutional cost basis from that point forward. But here's what most traders miss. AVWAP direction, it matters as much as AVWAP level. When price is below the static AVWAP, that's one read. It means institutions are holding a fixed cost basis and waiting for recovery. When price is below a falling AVWAP, when the institutional reference point itself is declining, that is categorically different. Institutions are not defending a level. They are resetting their reference point lower with each passing session. They are chasing price down. The VWAP deviation number alone, it tells you nothing, but the direction of the AVWAP tells you everything. So here's how all three signals map across the two scenarios, dip versus distribution. A dip is when the volume compression is coiled and energy is building. It has a stability of 1 out of 2 or 2 out of 2, and a base is forming. The AVWAP direction is flat to rising, which means the cost basis is anchored. The volume profile is clustering at support level. The swing age is mature, the trend is exhausted. A distribution signal is that the volume compression is expanded 0%, energy has been released. Stability is 0 out of 2, still dispersing. And the AVWAP direction is falling, the reference resetting lower. And the volume profile, the point of control, is well above price. The swing age is young, still developing. The more signals that read distribution, the more dangerous the so-called dip is. So when all 5 align, expanding compression, 0 out of 2, stability, falling AVWAP, point of control well above price, young swing age, the probability that you're buying into a distribution, not accumulation, is extremely high. And the key insight is this: these signals don't ask you to predict where price is going. They ask you to read what the volume structure is telling you right now. So let me show you this framework applied to a real name that most of you already know. This is Coinbase. And this is where it gets interesting, because right now the chart looks constructive. We bounce off the February lows. We're back above 197. The narrative is building that coin has bottomed. So let me show you what the IVT terminal is reading. The IVT bias is bearish. The VWAP deviation is minus 28% against a falling AVWAP. The confluence score is minus 1 out of 9. The swing age is 169 bars. It's a mature bear swing. The stability is 0 out of 2. Volume compression is building 78%. And Cantillon Flow is speculative. Liquidity is off, equity is off, and risk is the only thing that's on right now. And even the macro bonus is minus 1. So let's work through these one at a time, because they are telling a very specific story. Start with the AVWAP. The AVWAP deviation is negative almost 28%. But here's what the number actually means. This isn't 28% against a stable institutional reference point. The AVWAP itself is falling. It has been resetting lower with every session of this bear swing. A 28 deviation against a declining AVWAP tells you institutions are not defending a level and waiting for recovery. They are chasing price down. The reference point itself is moving. Stability is still 0 out of 2. That reading has not changed since February lows. We had a $50 rally off the bottom, and the volume profile has not consolidated into a base. No absorption, no accumulation fingerprint. What you're seeing in the price action is a bounce, not a base. Now, volume compression has shifted to building 78%. This is actually meaningful. Back in February, when coin was at 164, compression red expanded at 0. The bearish move had just released energy. Now at 78%, compression is reloading. The spring is beginning to load again. This is the first structural improvement we've seen in months. But, and this is critical, building compression tells you a directional move is forming. It does not tell you which direction. With stability 0 out of 2, and the bias still bearish, building compression in a bear regime is a warning, not an invitation. Look at the Cantillon Flow. This has actually deteriorated since the February report I released. The regime reads speculative. With liquidity and equities both in red and risk the only green layer, that's an inverted Cantillon sequence. Normally, liquidity leads, equities follow, and risk assets come last. Right now, risk is the only thing catching a bit, while the liquidity and equity layers are both deteriorating. This is not healthy foundation for a sustained move in a name like coin. Coin sits at the extreme end of the flow sequence. It is a layered equity proxy on a leveraged asset class. For a durable recovery to take hold here, you need liquidity conditions improving, equities receiving institutional flow, and the risk assets getting the bid. Right now, 2 of the 3 upstream layers are offline. The macro bonus is -1. Now, does any of this mean coin can't rally from here? No, it rallied 16% in a single session in February. High beta names can do extraordinary things on short time frames. The question the IVT framework is asking is different. Is the volume structure confirming a regime change, or is this still a distribution? The checklist answers that. VWAP deviation at -28% against a falling anchor. Stability at 0 out of 2 after a $50 bounce. Composite score at -5 out of 9. Cantillon Flow is speculative with the upstream layers red. Swing age at 169 bars. This bear move is mature, but maturity alone doesn't flip a regime. The one constructed signal is building compression at 78%. That's the one thing I'm watching. If compression continues building towards the Coiled threshold while price holds above the February low, that's the setup beginning to form. But setup formation and regime confirmations are not the same thing. The terminal will tell us when the regime actually changes. What we need to see is AVWAP reclaim. Price closes and holds above the institutional reference point. Stability moves from 0 to 1 out of 2 or 2 out of 2. Cantillon Flow shifts from speculative back towards accumulation, with liquidity turning green first. And volume compression entered Coiled territory, the spring fully loaded. None of these conditions are present today. One is building, the other 3 aren't there yet. The fundamental case for coin long term is real. Fortress balance sheet, Darabit acquisition, USDC dominance. The regulatory environment is improving. The infrastructure thesis is legitimate. But institutions don't position for a 3-year thesis when the near-term volume structure is still showing distribution. They wait for confirmation. So regime first, volume second, and price last. The most important shift you can do as a trader is from prediction to confirmation. Prediction asks, where will price go? Confirmations ask, what is the volume structure telling you right now? So what would it look like in coin or any name in this setup to confirm a regime change? Here are the 4 signals I'm watching. Price closes and holds above the institutional reference point. This flips the regime from sellers rallies to buy dips. Stability rises 1 to 2 or 2 out of 2. The volume profile begins consolidating at a base level. Institutions are absorbing, not distributing. Volume compression enters Coiled territory. Liquidity has flowed through the full sequence and it is reaching risk assets. None of these conditions are present today, but the upstream's conditions are forming. The Cantillon sequence is moving, and when the terminal flips, we'll know before price confirms it for everyone else. That's the edge. Not prediction, confirmation before the crowd. Every day the IVT terminal reads 0 out of 2 stability and expanded compression. The structure is telling you the same thing. The sellers haven't finished. You can disagree with it, it's okay. You can fight it. But institutional volume doesn't lie. It just takes time to show up in price. The traders who consistently get hurt buying distribution are the ones who lead with price and ignore structure. The traders who constantly buy real dips are the ones who wait for volume confirmation before committing. If you want to track these signals live, volume compression, stability, AVWAP deviation, and the full Cantillon Flow sequence across equities and crypto, I update the IVT terminal every single trading day. The link is in the description, cantillonresearch.com. Free subscribers get the macro regime read and framework context. Paid subscribers, they get the fully daily brief, specific AVWAP levels, confluence scores, and precision management frameworks for active instruments. If this framework changed how you think about the next dip, hit the subscribe button. I publish these every week. You won't get it anywhere else. So trade safe. See you. Bye bye.